India VIX has now jumped by 21%. Suddenly we have India VIX which is now at 18 times. This
18%.
is 18%, and this is not something that we had seen. Even on days of expiry, we haven't seen such big moves. We were trending between the 13 to 14 VIX range for the longest time, and today suddenly there is that big spike of 21% as far as India VIX is concerned, and no sector has really been let go of. So except auto, which is seeing a bit of a result reaction, Pankaj, pick up any other sector, they're all trending in the red. Whether mid cap, large cap, there is this inherent selling that's happening with no buying at all in the market at the moment. And if you look at the advances from the F&O universe as well, just a handful.
Absolutely, it's handful.
Or a large cement company is lost, which is the ACC Ambuja combined. Now they are the second largest in terms of size and capacity. If this kind of a market erosion can happen, it is absolutely impossible to sugarcoat this kind of a fall. Let's understand the factors behind the fall. Are they local in nature? Are they global in nature? Of course, they are global in nature. Of course, they are local in nature. It largely got triggered because of the sell-off what happened in Adani Group of companies, Ambuja and ACC included, and that in a sense has led to this kind of a market mayhem. Fear always feeds fear, and that's what markets are about. So the snowball effect, when something fell from on Wednesday, has really having an excruciating impact across the board in stocks now. The market momentum this year was not looking strong at all, and adding to that is this entire rift of money which is moving away from market like India, which has been a pattern for 2022 so far, is only getting multiplied. The market breadth is completely dented, and since we are less than a week away from the budget now, the desire to participate and the desire to trade long, I think is just not there. Everybody is waiting for the budget. Everybody is waiting for the clarity. So even though stocks may reach or are reaching that entry point where you want to be a buyer, you are delaying your decision. So small selling is having a large impact, and absence of any kind of a commitment coming in from the HNI crowd and from the institutional crowd is just making the fall look very, very magnified. We'll talk about the factors which in a sense have attributed to this kind of a market mayhem, but for a market which was chugging along very smartly till about earlier this week, now suddenly has reversed. So the falling is excruciating. Adani Group of stocks, they've lost almost 15 to 25% in terms of market cap in a matter of just 2 trading sessions. Call it the impact of the Hindenburg report, or market positioning reversing completely, or fear coming back. This is a sell-off which is rarely to be seen, especially when the sell-off is only confined because of local factors. Of course, we've seen sell-offs like these, Pankaj and Anisha, in the past, but those were attributed to global factors, 2008, COVID. This is a very localized sell-off. It is happening at a time when global factors are strong and supportive, whether it's a dollar index or flows into emerging markets or global markets. So it's the local fear, lack of buying, key event risk, which is budget, and excruciating pain in an otherwise performing group, which is the Adani Group of names, which is leading to this market mayhem. Now, there's nothing wrong with banks, but banks have led the decline. So it's one of those phases in the market where fear is fueling fear and selling is feeding selling.
So, Nikunj, how does one cope with this entire fear and mayhem? What should one do? What would be the advice? Just stay put for now. Don't get the FOMO to maybe, let's say, dive into the market. At the same time, don't look at booking losses, because they're deep losses.
So it really depends on entirely what your time horizon is, what do you own. Everything is getting right now painted with the same brush, and that's typical of the market. In the short term, it's the sentiment which will always have an impact. It would be compulsion in terms of risk management, which will always have an impact. So the first basic approach every time when you sell off is try and identify the reason. I think the reason in this case is very local. It is not structural. It is not something which has changed in terms of the earnings trajectory. It is not something, there is some kind of systemic risk. That's one. Second, what are the holdings you have, and how many of the companies which you own will get affected because of the sell-off which has happened in Adani Group of stocks, or the sell-off which is happening in the banking stock. See, if you are a trader, you need to understand that trading is all about understanding trend. the trend has reversed decisively. And when the trend reverses decisively, you need to honor the stop losses. You cannot be emotional in this kind of a market. I think it's too early to buy this market also, Anish and Pankaj, because you don't know what can come out in budget. The market mood is so fragile that you're overreacting to bad news, you're ignoring good news. I think IT numbers were perfectly fine, but the market reaction was not there. Bank numbers were perfectly fine, but the markets did not react there. So markets are not reacting to good set of numbers. You don't know what will come on first of budget, on
Right.
first of Feb.
Nikun, just wanted to understand about the markets that, first you saw the group seeing sell-off, then you saw some of the leverage names going down, and now you are seeing the, so-called coming on the banking names, the more leverage plays. So you think high beta is the one that one has to watch out for? How do they recover? What really happens, or what happens in the second half? Because we still have about 2 hours of trading session to go.
So Pankaj, what gives me hope is that this is not a global-led sell-off. I go back to that same point again. The dollar index is on our side, global markets are on our side, FIs have sold, but it is not that something has structurally changed for markets to see a mass exit. So sooner than later, closer to budget, after budget, if all goes well in the budget, the selling in the market will fall. However, there are pockets where even though the temptation to buy stocks would be there, you should not buy into them. That includes some of the high leverage businesses. That includes some of the high debt companies. Right now, you are in that phase of the market that protecting the portfolio is far more crucial than generating absolute return. So it makes sense to stay with your defensive stocks. It makes sense now to stay with some of the companies which do not need a lot of capital to grow. When a typical sell-off happens in the market, leverage companies, they always go down. That is followed by banks, and then that is followed by companies where there could be a business cycle disruption. What you got to understand is that where is there going to be business cycle disruption because of the market sell-off, and I don't think that's going to happen. So the economy, I don't think because of the market sell-off is going to suffer. Of course, markets will start speculating now that what will be the impact of Adani Group of companies, because they are they've taken a lot of debt from the market. So that is something which markets would speculate. So banks which were in uptrend now suddenly will be on the watch list, so to speak, for everybody.
Oh, well, yes, but just playing the devil's advocate here, given the sharp correction we are seeing, is there a case perhaps for a rally post-budget is out of the way? Are we probably poised for that? That's another question to watch out for. And as even Nikunj pointed out, it doesn't change anything for, let's say, IT as a business, or even, let's say, manufacturing, defense. These were the verticals that were doing well, whether the railway-led capex theme, industrials, defense, manufacturing, because PLI is supposed to be one positive that we are expecting from budget. So those things inherently do not change, or at least haven't changed in the last 1 week. So why a sudden reaction in the market? That's the question we're asking, and we'll try and analyze it further, because for now we are seeing a deep correction in the market, 17,533 at the moment. So of course, forget the mark of 17,770 thereabouts, which was a crucial level. We are much below that mark. And also the Sensex is down 1100 points. We also have now Mr. Jay Bala joining us on the show to talk to us about the technicals of the market. Jay, there is an inherent weakness, no buying at all at lower levels. Where are we headed? What's the bottom for the market?
It's too early to talk about a bottom. I think now we got considerable amount of downside to work with. And I've been highlighting this for some time. This market is set to go below the June low. That's the eventual bottom. But we could see extreme short-term relief rallies that may come through. But do not mistake that for change of trend. The trend is firmly down. And the nearest important level for me is 17,428 on Nifty spot. So if the market prints 17,428, not even a close, just a print, it will confirm and extinguish all remaining hopes for the bulls that the market is headed for below the June 2022 low.
Nuresh is also with us. Nuresh, good that you're there in our studios today, but what is the sense that you get? I mean, every 1 hour you're seeing a new low for the market?
So this is what happens in a waterfall move when margin selling gets triggered. So for example, the biggest carnage is in a stock called Ambuja Cements. Now if you look at the stock, the whole rally started in the stock at 330 to 360 levels, which is where the news came in for the takeover. It is below the open offer price. It is back to the whole price where it started from. It went from 330 to around 380 in the initial move, consolidated there, and then came to 580, 590 levels, which it peaked out. So if you look at it in terms of stocks which were to take the hit, they've come down to similar levels where it all started from. It may not be the case in the Adani Group companies, but in Ambuja Cements, ACC, etc. So that indicates a lot of say price action on the downside is already done. Because if we go back even to say Ambuja Cements, the low in March Russia-Ukraine crisis was between 300 odd levels. So at these prices, a lot of pain is already done. So you look at Adani Ports, it's down to 550 odd levels. So a lot of these stocks have already taken the pain, and there has been a similar waterfall move across the whole banking space as well. So a lot of stocks are closer to 200 DMA. The Nifty is closer to say the 200 say exponential moving average is closer to 17,500, 550. We are there. RSI is getting closer to oversold zone. So at 17,300, 400 is where the rally started from. So I think at these prices there is not much to do, but we still have an event in place. So post the event, it would be much more clear. So if nothing bad comes out, I think we'll be looking at a sharpish bounce from there.
So
See, you have to go back to that factor and understand that what is the underlying factor for the sell-off. Is the underlying factor global? This is not a global risk-off rally. The dollar index is on your side. The gap between India's outperformance versus global underperformance, now that has got corrected. If you look at the market from the eyes of individual stocks, the selling I think is very excruciating, the selling is very acute. How are markets bottom made? Market bottoms are made when there is panic, when there is fear, when you are selling and then thinking rather than thinking and selling. These are typical signs when markets bottom are made. There is a terminal value of some of the companies which is getting ignored right now. When stocks like Ambuja Cement or even for that matter banks or PSU banks and State Bank of India, the way they are getting thrashed, it means that there is a compulsion which is at play. And that's the time typically market bottoms are made. You can argue about market downside getting opened if we don't come on the right side of the budget event, because the market mood is such that it will react to bad news and it is going to ignore good news. But the bottom line here is that historically, when we've seen in last 15 years, 20 years, every time you've seen this kind of an capitulation in individual stocks, that's the time you want to be a buyer rather than trying to panic. If you panic now, you already would be getting an exit which will be 15 to 25% lower in some of the individual stocks. So the downside is limited. The upside in coming months and in coming time frame is going to be much higher. Devin Choksi, good afternoon. I'm sure you'll agree with me.
Yeah, Nikunj, I think there are certain days which are, I think, terrible days for the market. I think this is one among them. Probably, I think the kind of panic has gripped the minds of people and the collateral damage is already happening in the market right now. What is more shocking and surprising, and I think I'm worried about it at the same time because it is also happening for the first time, it is basically seen that I think the instruments which are not coded in India, they have been created outside Indian market on the overseas shore. And using those instruments, I think the shorting has happened. Now, today it could have happened, I think, for Adani Group of stocks. I think tomorrow it can happen to any other group of stocks or any shopper stocks in particular, which could possibly mean that I think the wealth could get overnight destroyed for whatever reason, I think genuine or otherwise. It could get overnight destroyed. Is it not, I think, suggesting that the derivatives are completely weapons of mass destruction, which is, I think, being used right now at this point of time? And that is a worry. And I guess I think that today's unwinding of the position by most of the traders, of course, it is a forced unwinding because of the mark-to-market debits that will come to people for the long position that they are carrying. But more than that, I think people are not sure whether I think tomorrow any big name I think would get attacked because of whatever the instrument gets created outside the purview of the market. And maybe I think regulators also must be clueless, I guess. I think they are not also getting the clarity as to how to plug this kind of attack, I think, which comes onto the market and create this kind of panic or nervousness.
Okay. All right. Now, do we have a recovery coming in the Nifty? No. And folks, remember, you cannot look at the market from the eyes of Nifty. Because Nifty, frankly, if you ask me, has been the resilient instrument. Nifty has just not corrected. I think on a one-year basis, Nifty is still not down 10%. So Nifty has done very well for itself because of the combination of stocks. The problem, I think, is elsewhere. Adani Group of stocks, banking names, PSU banks, some of the overcrowded stocks are getting completely smoked. That happened even with something like Bajaj Finance, let's say when they came out with the quarterly update, Asian Paints post numbers. So it is a very local factor. It is not a global factor which is at play. Second, when you see these local factors which are at play, once the compulsions of selling and margin and the price adjustment and the P&L, those factors are taken care of, I think that in a sense is adjusted. Devin Choksi, allow me to ask you a direct question. Adani Enterprise now has fallen below the FPO price and way below the FPO price. The book opens for retail on Monday. What happens next?
Good question. No answer, Nikunj, because I think your book is opening at a price which is higher than I think current market price. Honestly, I think the investors who are putting in money, they will also be fighting this particular situation. And nobody would like to pay premiums because I think the stock is available at a discounted price. So this is going to be a challenging situation.
Situation indeed, but at least for what it is worth, we are off the lowest point for the Nifty. There has been a recovery of almost 60 to 70 points, and individual names with respect to at least Ambuja, ACC, etc. seeing a bit of recovery. And let me tell you some trivia as well. Ambuja Cement is down the most since its listing in July 1997. ACC is down the most it has been in the last 31 years. So make no mistake, these are very big moves that we are seeing on the counters, but the recovery is also looking a bit sharp. Naresh, if I had to ask you to stick your neck out, would you be a buyer at these prices for the likes of Ambuja, ACC, Adani Ports?
So I would be a buyer in Ambuja Cements. That is something which has come back to the same prices. You're getting it, remove out the whole Adani factor and the stock is at the same place. So it is available at the prices in March 21. So at 345, 360, I think it's a good entry price if somebody has the ability to accept downside risk or volatility from here. I may not go into Adani Enterprises or Adani Total Gas, but the other stocks which have taken the hit, which are not, which have not gone up like 500%, 1000%. So that is where maybe even if I have to go in Adani, I'll go in Adani Ports. That is seeing the maximum selling due to FI exposure there. The rest of the companies don't have so.
You have to understand that the Ambuja acquisition or the ACC Ambuja acquisition was done via pledging of shares. It was an acquisition which had leverage at play. And typically, just to explain it to our viewers, that you give a collateral, and when the collateral of the value reduces, then if you're not able to produce more collateral, automatically there would be a margin pressure which will happen. So that really explains that why the sell-off is there in Ambuja and ACC, and it's actually higher than what other Adani Group of stocks have seen. The silver lining what I see here is that the institutional ownership in Adani Group of stocks, I'm taking Ambuja and ACC out, is very low. The retail ownership in some of these stocks is very low. These are stocks which are there in F&O, but the free float is not very high. Excepting Adani Wilmar, which is a recent IPO, the other Adani Group of stocks do not have that high retail or institutional activity. So while optically those stocks have fallen a lot, and they will have a rub-off effect on banks and other stocks, but the NAV damage on individual mutual funds and individual portfolios will not be there. Of course, HNI investors will see, some kind of an excruciating fall. But this is not like a global sell-off which has happened like GFC crisis or 2013 taper tantrum, or this is not COVID sell-off. The way prices are falling, it reminds you as if it's going to be, the sell-off is in similar on lines of what we've seen when there have been TMT crisis or GFC crisis or COVID crisis or taper tantrum. Is the problem that large or that unreal? The answer to that is no. Yeah. So if the problem is not that real, then the sell-off in the market will not be that unreal, given where the index, the dollar index, where the positioning of the economy is, where the inflation is headed, and where the earnings season has been. That's my limited point, which gives me some kind of an confidence.
So, to give you a statistic, Adani Enterprises, say as of September, had only 2.5 lakh retail shareholders.
There you go.
It used to be 70,000 before COVID. Adani Power has more shareholders. And for example, Yes Bank has 47.5 lakh shareholders. Tata Power has 30 lakh shareholders. And the float is really low in most of these stocks. If the float were higher, say the total market cap as of Adani Group was 16-17 lakh crores. But that is higher than Reliance Industries. But the weight in Nifty is less than 2%. The only place which really has a weight and is taking a knock is Nifty Next 50, where the Adani Group has, say, 8 to 9% weight.
I'll tell you what is surprising me, just for Rahul is getting ready. Rahul Singh, I'm coming to you, is that we've not got a very concrete response from the Adani Group yet. Why?
Clarification.
Why is that we've not got a very concrete response from the Adani Group yet? I mean, they're aware of what's happening in their stocks. They're aware that they have to raise capital. That's one. And second, now that Adani Enterprise is way below its offer price, IFPO price, what happens there? Because You've got a large IPO, FPO, where anchor investors have come in. That's 3,500 crore. Rest is retail and HNI investors. And why would a retail guys come in when the prices have gone down below the FPO price? So the FPO prices, it needs to be changed. What happens to anchor investor? So for me, that line of communication coming from Adani Group in terms of clarification on the report and explanation, clarification and explanation, and how the FPO will sail through. Because if the FPO does not sail through, sentimentally it's actually very bad news per se. Rahul Singh, good afternoon. Are you there?
Yes, very much. Thank you.
I can see there is a lot of confidence in your voice. So you're not perplexed with what's happening in the market.
I think overall, if you look at last 1.5 years, we have seen that there is some kind of valuation discipline which is coming back in the market. So what we see over the last 1.5 years are basically culminating into continuation of that process. We see no major difference in how the markets have behaved or markets have treated some of these sectors or some of these segments which had got overvalued, starting with the e-commerce, internet, and has carried on from there. And it's also been evident in some of the quality names we have seen over the last 6 months. So it's all part of the package.
All part of the package, but not sure if somebody signed up for a deep cut like what we are seeing today. I wanted to come back to you, Jaybala, and understand. You talked about where the weakness is and there's more downside at the Nifty level, but where does one hide? Which is that pocket which looks the most strongest to you? Is that IT? Is there defensives like pharma, etc., FMCG? What are you looking at?
I would say there are 2 pockets to hide. One is cash. Another one is, to a very small percentage is IT. The reason I say cash, if you go to cash now, say probably a few months down the line, you'll probably have the same portfolio that you have right now and a lot of cash with the same level of, shares that you're holding right now. So, you'll have a lot of cash left over. And IT is, I'm thinking it's a short-term outperformance, and you want to be very selective there. Stocks like Persistent and Coforge are outperforming, and probably will continue to outperform for a short while from now. But if we can't find sharp picks like that, you are better off being in cash.
What about these heavyweight SBI, Reliance, HDFC Bank, ICICI Bank? Any word there, Jay?
All 3, I had tweeted out on all 3, and Reliance is coming out of a medium-term head and shoulders top. So, the price projection is quite lower. And ICICI had put out a tweet on the 2nd of December, and I had said that the stock has peaked, and SBI too is in the same category. They've all got a considerable amount of downsides to work with. I would say at least 15 to 20% from current levels.
We'll let you go on that note. Thank you so much for joining us and talking to us, because definitely need some sage advice at a time when the market is so volatile. But Rahul, let me come back to you. We have talked about the near-term volatility. We have talked about how the market is probably getting impacted by a whole host of other stuff as well. But in terms of the long-term view, right? Not much changes. Nothing has changed in the last 1 week. If at all, there's a positive event perhaps which is lined up in terms of budget, wherein we are all expecting a lot with respect to manufacturing, PLI, capex, etc. What does one do if you have a long-term view?
So I go back to what I mentioned. I think there are 2 trends emerging in the market. One is economy is going from just being consumption-driven economy towards investment cycle-driven economy, and also from a very, very long period of a market where valuations not matter or stop mattering much. We are going into a market where valuations will matter or have started. So these 2 trends, I think, together is what we are keeping in mind when we look at our portfolio allocations. And I think there are sectors, or there are companies which are much more much more capable of delivering returns in these kind of environments. There are stocks which are reasonably priced where we can take advantage of these changes which are happening in the economy. I think those are the sectors or companies which are going to do well. And overall, as I was trying to imply, I think at the index level, maybe the returns may not be meaningful, or maybe we have a flattish kind of a year again. But below the index, I think these two trends which are emerging or have started to emerge gives us a good opportunity to create a portfolio which can outperform the market. I think that's been our focus. And of course, as an economy, as I mentioned, I think the single biggest change which is happening is just the shift from being just a consumption-driven GDP growth rate to something where I think investment cycle is also going to play a part. And I think budget is going to help do that. Budget is a small part of that. Budget is going to be
Now
pro-growth.
just request you to stay on with us. Request Jay and Nuresh to be with us, taking a break, coming back quickly. Nifty down 312 odd points as we take this break.